Welcome, dear traders. After a rather dull trading session on a Monday, stock markets were turbulent early Tuesday. Meanwhile, China's crippling real estate sector continued to affect stocks in Asia. In Japan, investors sold cheap stocks after a national holiday celebrated yesterday. It's me, Kate Stichina, and you are watching a recap of the Asian session on September 19. Despite a modest rally on Wall Street the day before, Asia-Pacific equities were in the red today. With all the important central bank meetings this week, risk sentiment faded in the market. The Japanese Nikkei was hit hardest by the deteriorating sentiment, losing more than 1% at the beginning of the Asian session. However, cheap and artificial intelligence stocks dropped, amounting to about half of these losses. Notably, the Japanese markets were closed on a Monday for a national holiday, so markets reacted to the TSMC news only today. And yesterday, TSMC, the world's largest chip maker, had asked its major partners to delay shipments. China's weak economy, especially its real estate sector, remains a major concern for the Asia-Pacific region. However, positive news from major Chinese developers has eased some of the fears. For example, Country Garden received approval from creditors to extend the maturity of a series of bonds. A similar company, Sunac China Holdings, also received approval from creditors to restructure its $9 billion in debt. Needless to say, all this drama is weighing on the Chinese currency. In addition, the yuan has come under tremendous pressure this year due to the sluggish economic growth in China and a series of interest rate cuts by the central bank. The People's Bank of China will release its decision on the key interest rate tomorrow, and the Federal Reserve will also decide on interest rates tomorrow, although fears of a recession in the United States economy have eased. A possible crisis is looming on the horizon. The fact is that 2-year and other short-term bonds continue to yield more than long-term treasuries. An inversion of the yield curve is an unusual phenomenon. Historically, it has been a frequent sign of a recession. Another red flag is the leading economic indexes. Analysts believe that when the leading economic indicator falls by 3% or more, a recession has always followed. It has been 15 months since this level of the index has been published. For comparison, the longest time between such a figure and recession was 16 months. At the time the Great Recession began. If the trend is correct, the recession may start in October. However, history rarely repeats itself. Investors are sure that the US Federal Reserve will leave interest rates unchanged tomorrow, leaving room for another rate hike by the end of 2023. The US economy has so far shown resilience on the back of hawkish actions of the US regulator. Moreover, the inflow of foreign capital into the United States has reached a 6-month high. In July 2023, foreign investors bought more than $140 billion in the US long-term and short-term securities, according to today's reports. And these numbers are not only the highest since January. These figures also confirm the US economy's global leadership. Therefore, the US Central Bank can afford to make decisions without any haste. Most likely, Fed Chief Jerome Powell will refer to the dot plot and inflation expectations at his press conference tomorrow. Of course, fundamental data drive the forex and interest rate markets. As a result, the US dollar and Treasury yields are trading within narrow ranges today below recent highs. Early Tuesday, the greenback attempted to break its two-day losing streak, trading slightly higher in the range of 105.00 and 105.20. However, the decline in the US Treasury yields went heavily on the US currency. In the Asian trade, the US dollar index, which tracks the US dollar against a basket of 6 major currencies, managed to stabilize at just above 105 points. The Japanese yen also went into standby mode. The currency jumped to 147.90 against the US dollar in the early Asian trading, but then slid to 147.50, a lower boundary of the trading channel. In anticipation of a Fed pause and comments from Japanese officials, a weaker US dollar is keeping this pair from gaining much ground. Notably, the Bank of Japan's interest rate decision will be released on a Friday. However, it's not as important as the news from the US Federal Reserve. Most likely, the Bank of Japan will not reverse its ultra dovish monetary policy. Meanwhile, investors tried to find hawkish hints in the recent speech by Katsuo Ueda. However, they misinterpreted his statements. The Japanese authorities have made it clear that wage levels remain the main criterion from this. This means that a change in monetary policy will only be possible if Japanese earnings and inflation are in line with the central bank's targets. However, Minister of Economy, Trade and Industry Nishimura Yasutoshi said that the ultra-loose policy would eventually come to an end, and the yen strengthened on this comment. In Australia, investors digested news from the Reserve Bank of Australia today. Early Tuesday, the minutes of the bank's September meeting were released, and they confirmed that monetary policy would be based on incoming data and risk assessments. The Australian dollar little changed on this news. In addition, the antipodium currencies could be influenced by the widening gap between the US and Australia's monetary policies. Today, the Aussie was driven by the moderate risk sentiment against the news that the Fed was expected to keep its interest rate unchanged. The Aussie also rose as a commodity currency, soaring to 0.6455 during Asian trading. Oil prices increased for the fourth session in a row, and WTI futures are trading just below the 10-month high, reaching on a Monday. As a result, the Aussie started a short-term bullish trend early Tuesday, trading in a range of 0.6428 and 0.6460. However, the bearish momentum in the Aussie dollar pair persists, according to technical indicators. The resistance level is located at 0.6520, and the support for the Australian dollar is at the breakout point near 0.6360. The New Zealand dollar also took advantage of elevated oil prices and climbed to 0.5935. Taking into account that the country's central bank will hold a meeting on October 10, the Kiwi can hardly count on the support of its regulator. Therefore, the currency will depend entirely on the US dollar and its impact on the commodity assets. This morning, the greenback retreated while crude rose. As a result, the Kiwi dollar pair strengthened on the daily time frame within the range of 0.5904 and 0.5942. Awaiting the Fed's decision, the dollar-rupee pair was trading in a narrow range of 83.20 and 83.25 today. Early Tuesday, the pair remained at more than a 1 month high reached on a Monday. In September, the Indian rupee depreciated above 83 and hit an all-time low level against the US dollar. In addition, signs of increasing capital flight from India were reinforced by high import prices. As of October, the technical situation is also leaning in favor of the bullish trend. The euro-rupee pair has been trading in a bearish range over 89 and 88 and 96 since yesterday. And that's all for now. Leave your comments below and don't miss our next video review. Remember that staying up to date is key to success in your trading. See you online soon.